What's up everyone? Welcome back to Stock Predictor. Today's video is going to answer a question that so many dividend investors are asking right now. Should you buy these 5 dividend stocks that are trading near their 52-week lows? Because here's the thing. When high-quality dividend stocks drop to their lowest level of the year, investors like us get an opportunity that doesn't come very often. But, as always, not every stock at a low price is a good deal. Some stocks are cheap because they're broken. Others are cheap because the entire market is overreacting. And that's what we're going to break down today, one stock at a time, with full transparency, cash flow, dividends, long-term outlook, valuations, and the real risks that Wall Street isn't talking about. So grab your notebook, because if you're trying to build passive income or compound wealth over the next 5, 10, or 20 years, this list could literally change your entire dividend strategy. Before we jump in, make sure you're subscribed to the channel Stock Predictor, because we drop real, data-backed investing content every week that helps you make smarter financial decisions. Alright, let's get into stock number 1. Stock number 1 is Intel. Intel has been trading near a 52-week low, and honestly, this stock has been one of the most debated names in the market. Investors are split. Some think Intel is a dying chip company, others believe it is in the early stages of a major turnaround. Here's the truth. Intel still has one of the strongest balance sheets in the semiconductor industry. Whether investors like it or not, Intel controls a huge portion of domestic chip manufacturing capacity in the United States, and that matters because of the CHIPS Act incentives, government contracts, and national security priorities. Yes, competition from AMD and Nvidia is real. Yes, Intel has had major manufacturing setbacks. But when a company this big, with a dividend yield that becomes more attractive as the stock falls, hits a 52-week low, you can't ignore it. The risk is execution. If their foundry business doesn't rebound, the stock could stay depressed. But if Intel actually succeeds in building out USA-based manufacturing and licensing customers, you could be buying a long-term rebound story at one of its cheapest valuation points in a decade. Investors need patience with this one. It's not a quick flip stock, it's a long-term turnaround play. Stock number 2 is Verizon. Verizon has also been stuck near its 52-week lows, and income investors are staring hard at that big dividend yield. Here's the truth about Verizon. It's boring, slow-moving, and absolutely essential. Wireless carriers don't grow fast, but they throw off massive cash flow. Verizon has one of the highest free cash flows in the entire S&P 500, and that cash is what fuels its dividend. The reason the stock is down is not because the company is collapsing, but because the telecom sector as a whole has been under pressure due to debt, slow growth, and high interest rates. But if interest rates fall in 2025 and 2026, Verizon could see a valuation lift simply from reduced refinancing pressure. The biggest risk is competition, especially from T-Mobile, which has been gaining market share aggressively. But despite that, Verizon's dividend remains well covered. If your goal is passive income from a stable, defensive sector, Verizon is one of the few high-yield names trading at a discount. But remember, this is not a fast-growth stock. This is a steady cash flow machine that rewards long-term holders. Stock number 3 is Altria. This is one of the most controversial dividend stocks in the entire market. It's trading near its 52-week low, and every time it falls, investors ask the same question: is the company dying? Or is the stock extremely undervalued? Here's the truth that most people don't understand. Altria still generates insane cash flow from its core cigarette business, even though volumes decline every single year. They raise prices aggressively, and those price increases more than offset the drop in volume. That's why they've been able to raise their dividend for over 50 years. But the long-term risk is real: regulation, declining smoking rates, and the transition to smoke-free alternatives. Altria's biggest challenge is that it hasn't executed well in the reduced-risk product space. That's why the stock stays cheap. But some investors argue that at this level, the downside is priced in, and you're being paid a massive dividend to wait for a turnaround. If you're an income-focused investor, this is the kind of stock that can boost your portfolio yield. But if you want growth, this is not the company for you. The decision depends on your profile. Do you want high income now, or long-term growth? Because with Altria, you're not getting both. Stock number 4 is 3M. This company has been through one of the toughest periods in its entire history. Lawsuits, restructuring, slower industrial demand, and overall market fear have pushed 3M to its lowest price levels in more than a decade. But here's the thing, 3M is not a small company that can disappear. It's a massive industrial business with thousands of product lines, deep customer relationships, and decades of innovation. The lawsuits have weighed heavily on the stock price, but the company has been settling major liabilities and restructuring operations. The dividend has been a concern for investors, but they've taken steps to stabilize the payout. If the worst is behind them, and that's still a big if, this could be one of the most undervalued industrial dividend stocks on the market. But the risks are also higher than the other names on this list. You need to treat 3M like a recovery play rather than a safe, steady dividend company. If you believe in the turnaround, buying at a 52-week low gives you a huge margin of safety. But if more legal issues pop up, the stock could fall further. This one requires cautious optimism. And now, stock number 5, and probably the most interesting one on the list, Walgreens Boots Alliance. This stock has been crushed. Absolutely crushed. Trading at multi-year lows, losing investor confidence, restructuring leadership, closing stores, and dealing with shrinking margins. So the question is obvious, why even consider a stock like Walgreens at a time like this? Here's the answer. Sometimes Wall Street overreacts so aggressively that it prices a company for death even though the business still has massive real-world value. Walgreens still generates billions in annual revenue, it still has one of the largest retail and pharmacy footprints in the United States, and healthcare demand is not going away. The company is aggressively restructuring, cutting costs, focusing on profitability, and shifting away from failed investments. Yes, the dividend cut scared investors. But sometimes a dividend cut sets up the foundation for a stronger long-term recovery. This stock is risky, no question. But it also has one of the highest potential upside percentages out of the 5 companies we talked about. If they stabilize earnings and improve margins, the stock could double over the next few years. But again, only for investors who can tolerate volatility. Now that we've broken down all 5 dividend stocks at 52-week lows, let's answer the big question, should you buy them? Here's the truth, there is no single answer for everyone. These stocks fall into 2 categories, stable income plays and high-risk turnaround plays. Verizon and Altria fall into the stable income category. These companies still generate huge cash flow, their dividends are covered, and their industries move slowly. If you want reliable income with less volatility, these 2 companies might fit your portfolio. But if you're comfortable taking some strategic risk for higher long-term returns, that's where Intel, 3M, and Walgreens come in. These stocks could deliver massive upside if their turnaround plans work, especially if you buy them at 52-week lows when valuations are depressed and sentiment is negative. But you need patience and a strong stomach for volatility. So what's the strategy? The smartest move is diversification. Instead of going all in on one cheap stock, spread your investments. That way, you benefit from potential rebounds while protecting yourself from unexpected company-specific risks. You also need to look at your goals. Are you investing for passive income today, or long-term capital appreciation? Because dividend investing is not just about yield, it's about buying companies that can maintain and grow their payouts sustainably. Here's something most investors ignore. A stock hitting a 52-week low doesn't mean it's a bad stock. It just means the market is emotional. But you have to make sure the fundamentals support the investment. Look at payout ratios. Look at cash flow. Look at long-term debt. Look at the industry outlook. If the numbers add up and the company still has competitive advantages, then a 52-week low is not a warning sign, it's an opportunity. But if the business model is weakening, or management is failing, or the industry is shrinking, you might be catching a falling knife. And that's why doing your research matters. As an investor on Stock Predictor, you need to remember that building wealth through dividends takes time. Buying discounted stocks when they're beaten down can accelerate your financial growth, but only if the company recovers. That's why this list is not financial advice, it's a roadmap. A starting point for your own research. And every investor's situation is different. Some of you watching this may prioritize income because you're closer to retirement. Others may prioritize growth because you're younger and have more time. What I want you to take away from this video is simple. When high-quality dividend stocks fall to 52-week lows, you have an opportunity to buy value when others are selling out of fear. But you need to separate temporary problems from long-term structural problems. Let's quickly recap the mindset you need going forward. Intel, turnaround potential. Verizon, steady income. Altria, high yield but slow growth. 3M, deep value with legal risk. Walgreens, high risk recovery play. Depending on your risk tolerance, portfolio allocation, and financial goals, some of these stocks may be opportunities for you. If you got value from this breakdown, make sure to like the video, subscribe to Stock Predictor, and comment below which dividend stock you think is the best buy right now at 52-week lows. Your opinions help the entire community learn and grow. Thanks for watching, and I'll see you in the next video.